8.98%. That is not a stock price. That is not an interest rate. That is the S&P 500 3-month Implied Correlation Index. And right now, it is sitting near the lowest level it has touched in the 15 years this data has existed. Stocks in America's largest index are moving more independently of each other than at almost any point since Citadel, Bloomberg, and GMI started tracking this in 2011. Now, normally, when I bring you a chart that says near record extreme, I'm setting you up for a warning. You know, that's a Black Swan channel formula, right? But Black Swan does not necessarily mean negative. It could also be positive. You know, we look at the crack on the wall about the walls falling down. But today I want to do something a little different. I want to show you why this particular extreme, read the right way, might actually be the most encouraging signal sitting inside the market right now. Not despite being unusual, but because of it. Here's a tension I want you to sit it over the next 10, 20 minutes or so. A low correlation can mean two different things. It can mean the calm before a storm, a market being propped up by a handful of mega cap stock while everything underneath is fragile. Or it can mean something healthier. Real stock picking, real differentiation, money rewarding companies for their own individual stories instead of moving in a one giant herd. Both of those readings are sitting on the table right now. And by the end of this video, you're going to know exactly how to tell which one we are living through and how to position yourself either way. This is the Black Swan channel, and today we're going a full deep dive on the most important chart in market right now, the S&P 500 3-month Implied Correlation Index. We'll explain exactly what it is and how to read it. We'll walk you through the last 15 years. We'll connect it with what's actually happening in the economy today. 20% of what follows is the news of the moment. 50% is where this goes from here, and 30% is the machinery underneath it. Every stock in the S&P 500 has options traded on it. Options prices tell you how much the market expects the stock to move over a given period. That is called implied volatility. The index itself, the S&P 500, also has options. And those tell you how much the market expects the whole index to move. And here's the clever part. If every stock in the index moves in perfect lockstep, all up together, all down together, then the volatility of the index would basically equal the average volatility of the individual stocks. But that almost never happens because stocks don't all move together. Some go up while others go down. That cancel-out effect is called diversification. It is the entire reason a portfolio of 50 stocks is calmer than one of those 50 stocks on its own. The Implied Correlation Index measures exactly how much of that canceling out effect the market expects. When the number is high, say 60, 70%, the market is pricing in a world where stocks move together like a flock of birds turning at the same instant. That usually shows up during panics because fear is a great equalizer. When everybody is selling, everybody's individual company stories stop mattering. When the number is low, like today, 8.98%, the market is pricing in a world where stocks are behaving like individuals. Some rally, some fall, and the index just average it all out. Look at the shape of this thing. You can see the tall spike of 2011. That's a U.S. debt ceiling standoff and the European sovereign debt crisis colliding at the same time. And the correlation index nearly touched 90%. You can see 2018 so-called Volmageddon, when a crowded bet against a volatility unwound violently. You can see the unmistakable spike in early 2020 when COVID hit and the entire market, every sector, every stock fell together in a matter of weeks. And you could see 2022 when the Federal Reserve aggressive rate hikes pushed nearly every asset class down at once. Now look look at where we are today at the far right of the chart. Not just low, structurally low, grinding lower for years, and the current reading sitting around 9%. That is a story we're unpacking. One more plain English translation before we move on, because I want everyone watching, whether you traded options for 20 years or you've never opened a brokerage app, to walk away with the same clear picture. Think of the S&P 500 as the choir of 500 singers. Implied volatility on any single stock tells you how loudly that one singer is expected to sing. Implied volatility on the index tells you how loud the choir as a whole is expected to sound. If every singer is belting out the same note at the same volume at the same time, the choir sounds every bit as loud as the loudest individual singer. Nothing cancels out. But if singers are hitting different notes, different volumes, different timing, a lot of that individual noise cancels out. The implied correlation index is simply a running measure of how much the singers are matching each other versus doing their own thing. And today they're doing their own thing more than they have in years. And this is what you need to understand about the correlation, is the fact that each stock is uncorrelated. That's a sign that the market is giving its independence. It's a sign that stocks may go up or may go down, but they're not going together. They live for their own intent. They have their own soul, essentially. And that's very important. That's very positive. History doesn't repeat itself exactly, but it does rhyme. And this chart has rhythm you can actually learn from. Every major spike on this chart in 2011, 2018, 20, and 22 has one thing in common. They were all moments when something forced the entire market to react as a single organism. A debt ceiling deadline doesn't care if you're a tech stock or utility. A global pandemic doesn't discriminate between industries. An aggressive Fed hiking rates to fight inflation touches every corner of the economy at once. In each case, correlation spiked because the driving force was macro, not micro, bigger than any individual company's earning report or product launch. The flip side is just as instructive. Every time correlation has fallen toward those low levels in 14, in 17, and in 24, those were periods where the dominant story was company specific. Individual business execution, well or poorly, individual sectors rotating in and out of favor without one single macro hammer coming down on everyone at once. So here's a historical lesson here. Stated plainly, high correlation usually means macro is in the driver's seat and it is scared. Low correlation means company fundamentals are in the driver's seat. The market has room to breathe. That's not a guarantee about what happens next. It's a description of what's happening right now. And right now, the description is fundamentals, not fear, are running this show. That is a nuance worth flagging, though, because I promise you the full picture, not the comfortable half of it. Low correlation has on a few occasions come right before sharp reversal. The market gets so complacent, so convinced nothing can touch it collectively, that when a real macro shock does arrive, the snapback in correlation is even more violent because it's coming from such a stretched starting point. We saw a hint of that in 2018. That's not a reason to panic. It's a reason to understand the mechanism, which is exactly what we're doing in the next chapter. Let us slow down for each of these moments because the details teach you, how to spot the next one. Right? 2011. That summer, two things collided. Washington was fighting over whether to raise the debt ceiling, flirting with an actual U.S. default, while at the same time Greece, Portugal, and the rest of the European periphery were in a full-blown sovereign crisis. Two separate microfibers burning at once on two continents. Correlation didn't just rise, it nearly touched 90%, meaning almost every stock in the index was, for a few weeks, basically trading as one single asset. Diversification as a concept briefly stopped working. 2018. Different flavor of the same lesson. That wasn't a debt crisis or pandemic. There was a crowded trade. A huge amount of money had piled into strategies that bet on continued low volatility. When volatility ticked up modestly, those trades were forced to unwind all at once. 2020 needs no explanation for most of you watching because, let's use it as a pure textbook case anyway. COVID-19 didn't care whether you own an airline stock or a software company. Both got hit hard. And in 2022, there was a Federal Reserve fighting the worst inflation in 4 decades. Notice a common thread across every single spike, a single dominant force big enough to override individual company differences. That is the tell. It's not bad news. That raises correlation. Plenty of individual companies get bad news every day, and correlation barely moves. It's news so large, so structural that no company can hide from it. In fact, this weekend I talked about that to my members. I discussed part of a book as to what happened when we have macro events. Because that is what you need to look for. You need to look for that macro event, that event that we don't know exists. Because right now, quite frankly, you know what? You let it happen, this market is going to keep ripping up to 8,000. Unless something that we don't know yet does occur. And that is what I do with my members every day. I've got wealth watchers. I've got tactician members, right? I offer them up to 10 separate tools, from live daily stock market commentaries, trade details, live weekend quant book reading, investment sheets, regime change update, chart of the day, prediction market analysis, Black Swan deep analysis, where are they now past trade, and more regime change. That is what I do for my members. Join us. And again, we're not here to predict anything. We're here to understand and understand risk management. And for that, it takes time. So what is the economic background, right now? As of early July 2026, what we're seeing is the S&P is trading around 7480, near the all-time high. The VIX, the most, watch fear gauge, is sitting around mid to high teens, around 16, which is calm by industry standard. Meanwhile, this correlation index is scrapping levels not far from its lowest point in several decades. What's driving the low correlation specifically are a few things. First, there's been a genuine rotation happening beneath the surface. Right? Technology and semiconductor names, which carried the index for much of the past 2 years, have recently cooled off, underperforming the broader index by meaningful margin. At the same time, sectors like healthcare, utilities, and industrials have stepped up and started leading. That's not everyone selling together, everyone buying together. That's a good thing. You want stocks to go down. You want price discovery, and that's money rotating from one part of the market to another. Sector by sector, story by story. That rotation is precisely what shows up in falling correlation. Second, there's something called a dispersion trade happening in the options market. In plain English, sophisticated investors have been betting that individual stock will move around more than the index itself. When that bet is working, it actually helps push the index volatility down and correlation down at the same time, because gains and losses across individual names are offsetting each other. Third, and this is the one to watch, there's a related but separate story about market concentration. For the past couple of years, a handful enormous technology stocks and AI-related companies have driven a huge share of the index total return. That's why you'll hear people say the market is narrow. But even data shows something interesting. The one-year correlation between the regular cap-weighted S&P 500 and the equal weighted cousin has fallen to one of the lowest reading ever, in the high 70% range. That sounds technical, but here's what it means in plain terms. The 10 or so biggest stocks have been doing so much of the heavy lifting that the average stock has been telling a completely different story than the index headline. I mean, markets don't move in straight lines, and they don't stay in one regime forever. Today, the data says stocks are behaving like individuals again, rewarding real research over herd behavior, and that is rare. It's a little fragile, like all rare things are, and if you understand it, really understand it, it is an opportunity, not just a curiosity. So don't forget to subscribe to this channel and become a member.